For the right investor, dividend-paying stocks can be a fantastic choice. Receiving that periodic dividend check can be truly satisfying. However, dividend-paying stocks aren't the best option for everyone. In some cases, investing in stocks that pay a dividend can be a big mistake. It's possible you are one of the investors that shouldn't be looking at dividend-paying stocks right now. Let's take a closer look at dividend-paying stocks and see if they are a good match for you. Welcome to the Seth Rain Money Guide, where we talk about all things money and different ways you can make money work for you. Today, we'll be going over reasons why you should avoid buying dividend stocks. Be sure to subscribe to the channel and hit that notification bell to get notified when we upload videos. We release videos every week and we don't want you to miss a single one. Also remember that we are not financial advisors. We are simply sharing our opinions about money and investing. Always make sure you consult with a professional financial advisor before making any major financial decisions. Let's continue. What is a dividend? A dividend is a payment from a company to one of its shareholders. A company can do one of two things with its profits. They can be reinvested in the business for future growth or paid to shareholders in the form of dividends. Companies that pay dividends usually do a little bit of both. There are two forms of dividends, cash and stocks. The majority of investors are familiar with cash dividends. In some cases, companies prefer to issue additional shares of stock in lieu of writing a check. A company can also utilize what is called a dividend reinvestment plan. In this approach, the dividends are used to purchase additional shares of stock. Investing in stocks that pay dividends can be a powerful investment strategy, especially if you're investing for the long term. But dividend-paying stocks aren't always the best choice. So when is buying dividend-paying stocks a bad idea? Here are 10 reasons you might need to reconsider investing in dividends. Number 10. The company is struggling. The dividend yield of a company can be particularly attractive if the price of the stock drops significantly. However, you should take careful consideration concerning why the price has dropped. If the stock is a good bargain, you should probably purchase it. However, be wary if the price has dropped because the company is struggling. In any case, the dividend is likely to drop in the future. Number 9. When the stock price is too high to justify the dividend payment. A 20-cent quarterly dividend on a $9 stock is a good deal. The same dividend on a $200 stock is not. Take a deeper look at how much the dividend is going to cost you. Look at the dividend yield while comparing different companies. The yield is the annual dividend divided by the stock price. Number 8. It's the wrong type of company. The top dividend payers are mature and don't have much opportunity for expansion. The ideal approach for this sort of corporation to spend its extra income could be to pay a dividend to investors. However, if a dividend is being offered by a new company in a developing sector, proceed with caution. That money would be better spent on further development. If a growth company is paying a dividend, find out why. It's possible that the company management team is making poor decisions. Number 7. The company is cash-strapped. When a company is running out of money, it has two choices when it comes to paying dividends: decrease the dividend or borrow more money to make the dividend payments. Either course of action is likely to hurt the stock price. Changes in dividend payment have a fast impact on stock prices. If the company is cash-strapped, proceed with caution. Number 6. The company's dividend payment history is erratic. Some companies pay their dividends consistently. Other businesses are significantly less dependable. Examine the dividend history of the firm in question. Dividend payments should, in theory, have been growing on a regular basis. In the past, how well has the firm matched its profit projections? It's a risky bet to invest in a firm that frequently fails to meet expectations. Number 5. When interest rates are too high. Banks can provide greater rates than dividend-paying stocks when interest rates are high. Before you buy any stock, keep an eye on how much banks are willing to pay. It's possible that your money might do better in the bank. Dividend-paying companies are more appealing when interest rates are low. Number 4. When you place a higher value on growth than on income. When you need a steady source of income, dividends are ideal. However, if you're a 24-year-old investor planning to retire at 60, growth is likely to be much more important. Before buying a dividend-paying stock, think about your investing objectives. Number 3. When your account's tax status makes dividend payouts less appealing. Dividends are taxed at the same rate as capital gains, which is lower for most investors than the regular income tax rate. Withdrawals from a traditional IRA account are taxed at ordinary income tax rates. This is the worst-case scenario. Withdrawals from a Roth IRA are tax-free if certain conditions are met. This is the most ideal situation. Profits from a conventional brokerage account will be subject to capital gains taxes. For most investors, this solution is a good compromise. Before you invest, be sure you've thought about the tax implications. It takes more than just glancing at the yield and placing a purchase order to invest in dividend-paying stocks. Dividend-paying stocks aren't necessarily the ideal investment for everyone. Take into account the company's strength, your tax condition, the company's history, and your investing plan. Simply because a firm pays a dividend does not imply that it is a smart investment. Perform the same basic research on this stock as you would on any other stock. Number 2. When buying dividend-paying companies, don't only look at the yield. Dividend yield is calculated by dividing the dividend by the stock price. This enables for simple comparison of stocks of varying prices. However, the yield is only one aspect of the equation. Consider the company's underlying financial condition. Some stocks have a high yield because their stock price is falling, and the firm has not yet reduced the dividend disbursement. Number 1. Avoid purchasing a stock just to collect the dividend. It is common for investors to try to buy a stock before the dividend is paid, and then sell the shares soon after receiving the dividend payment. The stock price, on the other hand, reflects the dividend payout. Examine a few dividend-paying stocks. Take a look at the price reduction once the dividend is finally paid. You'll soon discover the stock price will decline by an amount that is extremely close to the value of the dividend distribution. Keep in mind that stock prices take into account all publicly available information. Both the dividend payments and the date are easily accessible to the general public. Dividend payments are very appealing to investors. There's something gratifying about getting paid periodically as opposed to keeping a stock for 10 or more years and not making any hard cash in the meantime. Focusing on dividend-paying stocks might be an effective strategy in certain conditions. Dividend-paying stocks, on the other hand, might not always make sense. That's all we have for now. We hope you enjoyed our video and learned something new about when you should probably avoid investing in dividend stocks. If so, go ahead and hit that like button. Comment below if you invest in dividend stocks or are thinking about investing in dividend stocks. Please subscribe and stay tuned in the future as we will have more great videos highlighting other ways to help increase your wealth and build financial security. We'll see you next time. As always, take care.